Assalamu alaikum. Hopefully all are fine in this pandemic situation arising from COVID-19. Please stay at home and follow health instructions provided by authorities. Welcome to online class from Department of Accounting. Today I am going to discuss a very important topic named financial statement analysis, and these topics belong to Principles of Accounting course, and this course is entitled for honors first year and degree pass first year. So let's start. Financial statement analysis. So before starting our discussion, we need to understand what is financial statement. Okay, financial statements are a collection of summary level reports about an organization's financial results, financial position and cash flows. Here there are some important words: summary level reports. That means it should be very precise and very gist level report. And actually financial results means financial performance. It explores gross profit, net profit before tax, net profit after tax, and so on. And financial position, actually it is the list of assets, liabilities and owner's equity. And cash flows, how much cash inflows and how much cash outflows from the organizations at a certain period. It also represents a formal record of the financial activities of an entity. Here formal records denotes some legal value. That means it will give priority on legal aspects for upcoming situation. Okay, types of financial statements. There are 5 types of financial statements. Number 1, statement of financial performance, statement of financial position, statement of changes in owner's equity, statement of cash flow, footnotes to financial statement. So statement of financial performance, it is popularly known as income statement. Some others say it is comprehensive income statement. And statement of financial position, popularly known as balance sheet. That means a list of assets, liabilities and owner's equity. Statement of changes in owner's equity, that means it shows what was the capital at the beginning and what are the contribution of owner's equity at the end of the year, and what are the items that influence owner's equity. And so all things that influence owner's equity is included this statement. Then the statement of cash flow is very important. It presents how cash inflows and how cash outflows arising from different activities. Actually it shows the efficiency of an organization in case of capital management and cash management. Then last, very important, footnotes to financial statements. So it is very important in the sense that many argue that financial statements are 4 types, but these 5 I statements have some argument. So all explanations will not be found in financial statements. There are some explanations, notes, workings that are necessary to explain, to clarify the financial statements. For an example, depreciation. So depreciation, there are different methods of depreciation. So how we will calculate the depreciation? Like this, inventory valuations and other important notes. So this should be attached below the financial statements. And here at a glance, and there are 5 types of financial statements and definitions and important terms. So now come to our right topics. Definition of financial statement analysis. Financial statement analysis is the process of analyzing a company's financial statements for decision making purpose. So here decision making purpose is very important, and this statement analysis should be based on decision making purpose. External stakeholders use it to understand the overall health of an organization, as well as to evaluate the financial performance and business value. So that means any investor, anyone who wants to invest, he or she must understand the business value and the business performance and financial performance and that financial position of that particular organization. So this financial statement analysis is important for not only investor but also different type of stakeholders. So objectives of financial statement. There are different types of objective, but the primary and very important objective of financial statement analysis is to understand and diagnose the information. Information means financial information contained in financial statement with a view to judge the profitability and financial soundness of the firm and to make forecast about future prospect of the firm. So here there are some key points: understanding and diagnosing financial information. Then we need to assess profitability, that means how much the ability to generate the profit, and the financial soundness, that means financial health of that organization, and future capabilities, that means future prospect, that means we need to predict what will be the future performance of this organization. So in these cases financial statement analysis is very important. So techniques of financial statements analysis. There are mainly 3 techniques of financial statement analysis. Firstly, horizontal analysis. Secondly, vertical analysis. Thirdly and finally, ratio analysis. So horizontal analysis popularly known as dynamic analysis, trend analysis, comparative financial analysis. Actually, horizontal analysis is a financial statement analysis technique that shows changes in the amounts of corresponding financial statement items over a period of time. Here 2 key words is changes and period of time. So changes means amount of change. That means that there will be base year and we need to compare the existing balance with the base year balance. And it is a useful tool to evaluate the trend solutions. The statement for 2 or more periods are used in this analysis. So it is actually like time series analysis, and we need to take 2 or more than years to complete this analysis. Then this is the formula. This is amount change, amount of item in comparison and amount of the item in base year. So what will the increase or decrease, and the percentage change means increase or decrease amount divided by base year amount multiply 100. Here there will be illustration. So this illustration, so balance sheet horizontal and based by 2010. So just think the total assets. In 2009 it is the base year and 2010 is the present year. So that means base year we had total resources about 18,302 million dollar, and in 2010 it is 17,489 million dollar. So there is obviously decrease. That means it is 453 million. So what will be the percentage? That percentage will be the 2.5%. That means 453 divide base year's amount, that means 18,302 million dollar multiply 100, and it is 2.5%. That means 2.5% total resources decreases, okay, over 1 year. The next, so vertical analysis. Vertical analysis is also known as structural analysis, common size analysis. Verticals means up and down, and this analysis provides some tools that list each line item on the financial statements as a percentage of its total category. Actually, it's a method used to analyze financial statements by comparing individual entries as a proportion of the total accounts like assets, liabilities, and equity. Okay, then this is the formula from 2 point of view, then balance sheet point of view and income statement point of view. Here percentage equal to accounts balance divided by total assets, or account balance divided by net sales revenue. So here total assets will be 100% and net sales revenue will be 100%. So here there is another examples illustration. Just you look on here that total assets is $284,000 and among these total assets, total current assets is $42,000. So here it is 14.8%. That means 284,000 it is 100%, and among this 100% we have current asset 14.8. okay, and we can also think and analysis in this way by total current assets, property, plant, equipment, like this way. So you will find the same here in same way. So there is a difference between the horizontal analysis and vertical analysis. The horizontal analysis we need to do more financial years, but in vertical analysis only single financial year, and based on year and based on item. So how much increase and decrease it is considered horizontal analysis, and vertical analysis just we need to that total items is 100% and then individual items how much percentage it is. Okay, then the last and final ratio analysis is very important, and we will discuss in our next class. And I honestly request to all my students to read out these topics, these two analyses from your textbook. And thanks for listening the video, and thank you all.